Hey everybody, welcome to the Hart Investment Group look back, look ahead, our annual review. Most of you know us from our either being clients or weekly videos. But if you don't, I'm Scott Goodfellow. I'm the Associate Investment Advisor here at the Hart Investment Group. Today's presentation is about an hour long. Ben tends to go a bit longer than that, so you might want to block a bit more time off than that. We are recording it, so if you do have to hop out early, I am going to start recording it probably tonight or early tomorrow morning at the latest, so you'll be able to have that on file if you want. Just a couple of housekeeping things here. If you do want to ask a question, at the bottom, if you hover over the bottom of your screen, there should be a bunch of functions that come up. One of them is Q&A. That's the best way to ask questions today in this forum. So if you double click on that, chat box will come up. If you want to ask your question at any time, please do, and we'll actually stop and answer it as we go. That way it'll be most relevant to the content as we go. Okay. Without further ado, we'll get started here. Again, most of you know him, but I'd like to introduce Senior Wealth Advisor and Portfolio Manager, Hart Investment Group, Ben Hart.
Hello, thanks very much. For the people that were here early, they got my humming music to start off the presentation. Just trying to get in the right frame of mind here.
Well, that's what it takes.
Yeah, I'm excited. This is the 7th anniversary for me. Started in 2016, so excited to get going today.
All right. Well, why don't you kick it off?
All right, sounds good. Just let me get the presentation up here, and then we'll get on our way. Let me know when everyone can see it. We're good, Scott? All good?
Yep,
okay, perfect. Awesome, excellent. Okay, well, thanks everybody. Appreciate it. Thanks for joining tonight. As Scott said, I do try to go and spend quite a bit of time. Be lots of slides and charts and things like that. This year was lots of research came through. Citigroup had their forward-looking guidance with 100 slide pages. So lots I went through, tried to narrow it down, got a bunch of things to go through. But ultimately, we're going to give an update on where I think we are in the world, both from an economic perspective and from a market perspective. There's lots to cover. You know, 2022 was quite the year. Certainly, as I look back and watch the presentation that we did last year, you know, I think we got a lot of things right from an economic perspective. We thought the economy was going to stall in the middle of 2022, but from a holding perspective, there are some things that happened not exactly like we played out. So it's good to go back and look at what we learned, what we did, what we didn't do, and continue to try to get better. So thanks very much. Without further ado, let's get into the presentation. But I do have to start it off with this disclaimer. This is not intended to be investment advice. You should always speak with a licensed advisor before proceeding on an investment strategy. Everyone has their own risk tolerance, and you should adhere to that. This broadcast is for information purposes only and are the opinions of Hart Investment Group or any guests. So on to the rest. So got a few new people joining tonight, so just going to do a couple of slides on our process. I've been in the investment business since 2000, so 23 years now, I guess, this summer. Bought my first stocks when I was 13, so I've been interested in the market for a long time and started with kind of initial kind of valuations. Let's look at businesses, a la Warren Buffett. But as things have evolved over the years, I've refined my process to understand a little bit better about what's happening in the world. And so we start off with what's happening in the macro economy. And so where I get a lot of the research from is certainly some internal for North American perspective. We get that research, but primarily the economic data that we look at every day, it comes from a company called Hedgeye. It's an institutional research platform based in the United States. They do a global look at what's happening in the economy on a daily basis. They update the data sets every day to kind of give us a feel for what's happening in real time from the perspective of how do we look forward, because a lot of the economic data that comes through the system is backwards looking and is fairly useless. So they do a good job at projecting what's coming in front of us. So that's where the macro starts, what's happening. Once we've done that, we layer in the fundamental research and say, what's fundamentally happening in the world as well on a country by country basis, and certainly on a global overall fundamental basis. Then once we've done that and potentially identified some areas, hypothetically, maybe we look at Europe and we say, here's where Europe is. It's presently in a recession. Do we like the macro setup going forward from here? And then we'd say, is there a company, for example, like BASF that's down 60, 70% and has a good projection going forward? Is this something we want to look at implementing into portfolios? And so we'd look at adding individual stocks, bonds, ETFs, mutual funds, hedge funds, and also at times we'll use hedging strategies, which we effectively did in 2018 and 2020. So going into 2018 and the end of the year, Powell was tightening interest rates quite aggressively, spooked the markets. We had a pretty material sell-off in December of 2018. Markets were down about 25% for the month before he changed directions, and having some puts in portfolios provided some protection at that point. Again, coming into February 2020, owning some insurance and protection helped to support portfolios into the COVID crisis that we saw there. So that's our process in a nutshell. And then really just a little bit look on the client base, and then we'll get into details around inflation, expectations, etc. So the client base looks like this for us. We deal with corporations, associations, small business. So small business will be doctors, dentists, realtors, things like that. We implement investment and tax strategies for them. Basic investment planning and advice. So we'd be doing financial planning, investment advice. We have some clients that are in the active trading category, and the final piece is the multi-generational. So where we'd have 3 or 4 generations doing our best to provide for investment and tax planning to generational perspective. So I put this on last year and continue to think this is a major way of how I think about the future. And so these are 2 famous investors and economists. The key to successful investing is when everyone agrees with you later. So this is Jim Grant. So this is something that I've certainly battled with a lot of my career, is when I look at putting something in place today, it might not work for the first week or the second week or maybe in the first month or 2 months. But if you have a reasonable time frame where you're looking out 1 year, maybe 2 or 3 years, you can benefit from taking advantage of some opportunities, particularly like some that we see today. And the other famous quote that I always think is interesting is, be fearful when others are greedy, and be greedy when others are fearful. So that's a Warren Buffett quote, of course. Warren Buffett spent more money in Q4 of last year than he's ever spent in history. So it just gives you a little bit of context around how people are thinking about things and where certain asset prices are gone. Warren Buffett put pretty material investment in Taiwan Semiconductor in Q4 of last year when the stock was down about 60% off its highs. And so just as we look and take a quick snapshot of last year, I'm sure most of you know how that played out, but I look at a lot of cross assets and just picked a couple of spots that I kind of look at on a regular basis: Canadian stocks, bonds, US stocks, some global indices, some individual positions. And, the one thing that obviously you'll see when you look at this is that every major asset class around the world was negative, with the exception of the US dollar and oil. And so in this case, this would be US dollar versus CAD. So that was up about 7%. But the rest of the other major asset classes around the world fell into negative territory. So we'll discuss that as we move forward. But just to lay it out, there's kind of 3 areas, there's 4 setups that I look at from an economic perspective. I'm going to do my best to discuss kind of the economy and markets. They are interconnected, but they're not identical. So in the economy, there's 4 types of setups where you could have inflation and growth accelerating together. You could have inflation accelerating and growth decelerating. You could have both inflation and growth accelerating. And then you could have what we have right now, which is growth and inflation decelerating together, which is a recessionary type setup, which I think we've been in for a couple of months now. And so with that as the backdrop, here's my base case down the middle. So my base case is that we're in a recession presently, and inflation is moderating. And I think it continues to do so. We saw Canada inflation numbers softer this morning than expected. And so this is the base case. This continues. The recession evolves. Central banks go on hold. I've had numerous conversations with individuals and investors just around what's happening with interest rates, and that's a big question. So we can discuss it in more detail today. But I think we're close to the end, if not at the end. So we got the Bank of Canada next week on Wednesday, and then the Federal Reserve on February 1st. Of course, Davos is happening in Switzerland right now as well, where all the world central bankers are meeting as well. So lots to pay attention to there. But the base case is we stay there. Central bankers go on hold soon. What happens to risk assets in that period? Stocks, bonds, real estate, blockchain, crypto, any type of investment asset. What happens in that backdrop? You should see positive returns in that setup. And so what happens from a weakness perspective is likely to get a US dollar kind of move sideways to down in that backdrop. So we'll continue to watch that. So the negative case, the negative base case, which is inflation continues to be sticky. And, we go from a 6.2 inflation print to a 6.5 instead of going to a 5.8. That's when you start to put some pressure on the central banks of the world, where they have to continue to push on this getting inflation under control, continue to tighten financial conditions, continue to squeeze what they've already done. And so this would have a negative effect on most asset classes, with the exception of the US dollar. And the positive case would be central banks start to stimulate the economy. Well, I think this is a likely outcome, not this year, maybe in the back half of this year. And so I would look at this as what happens in that setup. And it is such where we think most asset classes do well in that, with the exception, of course, of the US dollar. And so that'd be the base case, and that's what we're going to be discussing today. And Citigroup laid it out in this format. We're at or near the end of the FOMC rate hiking cycle. That's the U.S. Central Bank. You start to see employment, which employment's been a big driver of how central banks of the world have been able to keep their kind of the pressure on, is because they say employment is so healthy. And so we're going to look at the employment numbers, but it looks like they're starting to roll over as well. Fed goes to a halt. U.S. global recession underway, which I think it already is. The market starts to anticipate a recovery. And, I think we've hit some of these landmarks already, but this is some worthwhile kind of visual to think about how this plays out, and the US dollar begins to fall in that backdrop. So thanks very much. We're going to talk about what worked, what didn't last year. We're going to talk about some of the strategies that I see coming ahead, what's been priced in, what's not priced in. We'll talk about holdings that I think can do well, and ones that I think continue to be under pressure. So, what do we do? How do we think about this? So have stocks fully priced in a recession? I believe that in some cases, yes. In some areas, yes. Bond yields appear like they've peaked in October of last year. So bond prices bottomed, yields peaked. So those are the inverse correlators. And so what do we do from here? And so let's talk about some of those holdings that worked and what didn't. So as I mentioned, the US dollar and oil, generally it looks like oil did work last year, but it looks like things have peaked. In March of last year, we had oil kind of spike up into the $120, $130 a barrel, and we're about $40 lower than that presently. And so that'll continue to be a drag here on inflation. So too will natural gas. US dollar as well is up kind of 10% versus the Canadian dollar, and up closer to 15% versus DXY, which is the basket against the US dollar. One of the things that we have in portfolios, which I've owned now for a couple of years, which is some market neutral hedge funds. And this is really to put yourself in a position to have some capital in the event that we see an event like we saw this year. One of the holdings was a Picton Mahoney market neutral fund. So this was positive last year, somewhere in the neighborhood of about 5% for the calendar year. So the reason this is great and why you invest in some of these things is it puts you in a position now to have some capital to take advantage of things that are down, 40, 50, 60% from their highs. You can benefit from using some of that money to get a bit more aggressive. And that's what I've been doing here to start the year. So what didn't? Pretty much everything. Government bonds, growth stocks, emerging markets, you name it. What didn't do well last year? Pretty much everything that involved any bit of leverage or volatility. had a challenging year. So this is, we're going to take a look at a couple things, but this is money supply. And so if you'd asked me 10 years ago, does money supply matter for stock and bond prices? I would have said no. However, as the world's evolved and the leverage that we have in the system now has changed, I think money supply is the primary driver of direction of asset prices. And so money supply is extremely important to what happens. And so, there's kind of two types of money supply, M1, M2. I won't get into the details, but essentially M2 is all of the money in the system, your savings, my investments, the central bank's investments, kind of the whole supply of money in the different countries. And so this is a view of money supply in Canada over the last 12 months. Well, this is obviously a historical number, but you can look at how dramatically that's fallen over the last 12 months. So you've seen this massive kind of sucking of liquidity out of the system, which has put pressure on all asset prices over the last year. Again, in the U.S., if we look at that same M2 money supply coming out of the system was massive. And in a future slide, you'll see that it's the first time that M2's gone negative since before the data started. So first time ever in the history of the tracking the data. So since 1960 to now, we've never had negative M2 in the United States. So some of the other things that we look at is sentiment. And so this is the University of Michigan sentiment indicator. And so these tend to be counter cyclical opportunities. And so as we look at as sentiment bottoms, these tend to be pretty material bottoms in risk assets. And so as we look back kind of the 70s, 80s, 90s, 2000s, we've seen some of these periods where we've dipped, and the current dip, which we saw was October of last year, was quite similar to what we saw kind of in the late 70s as well. And they've tended to be reasonable entry points as confidence erodes so much that people aren't willing to take any more risk. So it's important to think about sentiment because that also drives flow and money and things like that. So sentiment's an important gauge that I take into account when I'm looking at what you want to own. So last year we had quite the start to the year. And so I did the semi-annual presentation, I think late May, early June, sooner than expected, just based on the volatility that we had for the year. And so when we put out the report last year, this was the Bitcoin Fear and Greed Index. Again, another sentiment gauge for how comfortable or uncomfortable people are. And you'd gotten down to extreme fear. And then as we look at where we are today, we've kind of moved past that as we had a number of bankruptcies. We had FTX, which happy to discuss if people want to. But it seems like there's been a lot of things that have worked its way through the system, and some comfort is coming back to that as an asset class. Another place where I'd look at is the Global Fund Manager Survey. So this is the institutional fund managers in the U.S. Their positioning in a couple of periods. Again, the May period, which I put out, which was May of last year, and then September of last year. Again, these have been counter signals in some cases where we look at, they were massively underweight equities and bonds and overweight cash, commodities, and alternative assets. This is the time they should have been considering flip-flopping those. But that's positioning. And so as we look at, fast forward here to September of 2022, we get these fund managers that are compensated not based on how they do over a 12-month period. And so you get this kind of performance chase into certain things and protection of the portfolio where, you might not have the benefit of looking at your Eurozone equities and saying, this is an interesting place. Maybe there's some good companies in here. They tend to have good cash flow, low PEs, good dividend yields. Or maybe you'd look at emerging markets like the Chinese economy, which KWEB, the Chinese Internet ETF, looks quite attractive, and I've been talking about for a month and a half or so. These tend to be other signals that we'd look at that happen within the system that present opportunities. And so we'll talk about inflation, deflation, stagflation. So, if you talk to somebody 12, 14 months ago, nobody cared about inflation, but it's been front page story over the last year and a bit. And in one of the dailies that I put out this week, I said, I think inflation is the story of the past. I don't think it goes to 2% tomorrow or even next week or next month, but I do think we're heading generally in that direction where inflation is starting to slow, and it's not necessarily going to be the front page of what we need to worry about, what we need to pay attention to. And certainly, I'm not expecting deflation either, but I am expecting disinflation at this point. So let's just take a look at some of the things. But before we get into the discussion about inflation, I almost always, in every one of my presentations, people ask about what happens to politics and what does politics play into how things are going to move through here. So I thought this was an interesting look, just to have a sense. This was a HSBC report, just talking about, what is it, a positive or negative with a mixed house, with a mixed Congress, excuse me, better with a Democrat or a Republican. I thought this was a reasonable way to just look at it. It's slightly positive, the current setup we have, and so I'll just leave it at that. It doesn't make a big impact on how I think about things, but it's interesting just to think about potential impacts on fiscal policy. So as we look at where we are, and recession seems to be also something that's talked about quite frequently. This is a BCA research report. This is the annual forecast. And, over the years, it's made sense to be contrarian. Over the years, it's made sense to stay with consensus. And as the economic data gets more readily available and a much better job of kind of digesting into these forecasting tools, in this case, I think consensus is right. We're seeing inflation slow and we're seeing growth slow quite quickly. And so at least from a market perspective, we saw the S&P come down kind of 30+% from peak to trough. Last year, we saw the NASDAQ down kind of 40% peak to trough. The market is telling you saw bonds down 20% peak to trough. You saw the market telling you that a recession is coming. And now it's just a matter of time before, does the economy actually catch up to those forecasts? And how much of that's priced in? So in this instance, I think that consensus is right and that we are in a recession and headed towards one. The severity of it, we can talk about as I go through some of these slides. So this is just a dashboard on CPI. So, most people follow kind of core CPI, which is the number that gets published on BNN and CNBC. It's a view on what's happening in everything in CPI. I like to break it down as well, look at it in a little bit more detail. This is energy, food, services, apparel, transport, rent. And it's interesting just to look at the places, and CPI is really sensitive to what happened 12 months ago. So it's important to go, where are we today? What happened 12 months ago? What's the expectation about what's coming forward? And presently, it looks like inflation is slowing. And so if we look at this more country by country, the previous one was US data. So if we look at this country by country, again, we're seeing certainly more greens than reds, and greens on the right-hand column there would be trend versus prior reading. And so we would look at certainly the US and Canada. We're seeing those readings continuing to head down, obviously off of elevated levels. I understand, I'm aware of that, but it's the rate of change and the direction of inflation that matters for what happens to future asset prices. So some of the other positive points for what's happening with inflation is as we got into COVID last year, we saw a huge spike, of course, in shipping costs, which petered out, I think, till the end of 21. And we've seen a massive decline in shipping costs. And so that's primarily back to 2020, 2019, 2020 levels from a cost perspective. So this will continue to be a drag down on inflation as well. So this is another positive input. And so as we look at employment here, I like to look at private payrolls over the last 12 months. I think it's important to note that we continue to see this number slowing. What we also see, which isn't exactly in this data, is you're seeing you get multiple jobs. And so you get lots of people in the US that get double counted because there's many people that have 2-3 jobs to get to kind of their full employment numbers. And their participation rate continues to be presently right now 62%. So extremely low participation rate. So you don't have a lot of people coming back to the job market that left during COVID, particularly in the 55 to 64 range. So, the low employment is kind of a reaction function to what's happened. And I think we're starting to see it roll over. And if you look at any of the headlines here as earnings come out, whether it's Google or Facebook or Shopify, all these tech companies are announcing layoffs. And so, the data is saying such that what the companies are doing. And so we're starting to see that employment number roll over as well. And so this is where I think you start to get a look at how we think about what's coming ahead of us. And so, I've talked, for those who have been clients for a long time and who've listened to a lot of the things I've put out, ISM is something that I talk about, which tends to be what's the health of the economy. And so an ISM number above 50 means the economy is expanding. Below 50 means the economy is contracting. The fundamentals of it we could discuss another time, but simple as that: above 50 expanding, below 50 declining. And so if we look at ISM versus kind of forecast percentage of central banks cutting rates right now, this would be the blue line here that we'd be looking at, where ISM is up elevated in these levels. Presently, right now, the central banks have priced in the fact that ISM is probably going to be somewhere in the mid-30s. Mid-30s ISM is a pretty severe recession, but the question is, how much of that's priced in? And with the present data, a lot of that's priced in already. So, forecasting of a severe recession, what's that going to mean for asset classes, asset prices? We can certainly discuss that as we go. So to my point about liquidity, so this is how the data looks. So since 1960 to now, we've never had M2 go negative. And so as all of this money's come out of the system, it's put a pressure on any asset that is leveraged. And that's pretty much every asset in the world. Where you look at, stocks or real estate, everything is leveraged. So as liquidity comes out of the system, it puts pressure on asset prices. And so if you would have asked me 12 months ago and said, M2 went negative for the first time, I would have expected a lot of things worse would have happened than they did in the past 12 months. There've been more credit risk, there've been, bank exposure, some other things that we haven't seen. So I think the economy's been quite resilient with the amount of pressure that's been put on it over the past 12 months. So with that being said, this is how it looks from a visual perspective. Is we've had the major central banks pull out something in the neighborhood of $3.5 trillion in liquidity out of the system. And we're starting to see a bit of a light at the end of the tunnel. Well, that number's starting to go in the other direction. So you've had the Bank of China start to cut rates and stimulate the economy. And so we're starting to see some of the early stages of some of the liquidity constraints start to move in the other direction. That's a very positive sign from where we go from these levels. So what that looks like, if we're looking at M2 over forecasts for the economy, roughly, is that the M2 is already priced in that we're in a recession presently, and that M2 liquidity is going to start to come back to the system, and we're just seeing the early stages of it right now. A lot of people like to talk about, again, the 2s, 10s. So what's the 2-year bond rate? So kind of 0 to 2 years. That's what you hear in the media. The central banks of the world talk about, we're going to raise rates. And so they kind of control 0 to 2 years, we'll say. And then after that, the market tends to control that. And so right now, what we have is you have the 2-year rate above the 10-year. And so, that's historically been a signal that we're in or heading towards a recession. And so we see that 2s, 10s, quite dramatic here, something in the neighborhood of 80 basis points or 0.8%. And so really what that's saying to you here is that they're showing like the bond rates are already pricing in kind of a 35 ISM, which is a recession. And so that would say that bonds have already priced in, particularly in the 5 to 10-year range, have already priced in a recession. So as I read headlines, as I'm sure a lot of you do as well, there's kind of this support thinking that, savings, all the savings that people had during the COVID crisis will bail us out, will save the economy, so to speak. And so if you look at the data, this is US data, Canadian looks quite similar. You've seen a number of things, but this is it. Essentially, all that savings has gone away and been spent. And if you look at the credit card data, 12 months ago, 78% of people were paying off their credit card every month. That number now is closer to 40%. So it just shows that people have gone through their savings and they're starting to use their credit cards as well to kind of support what they have. So, you know, we're in that right now. And the objective is to, what do we think about that? And what do you think about what's coming ahead of us? So a couple more on these. This is housing, you know, the US housing market. And US housing market and the Canadian market is a little bit different. We'll talk on a couple more slides in the future on that. But this is US housing. US housing has corrected quite dramatically. If you forecast the ISM on top of that, you get kind of a 30 ISM, which shows pretty recessionary numbers. And so I'd say from a positive perspective, that could present some opportunities in US housing. So longer term inflation expectations, again, we could argue and debate what's going to happen with inflation, why, what some of the risks are, and I think there's plenty. But at least what the longer term inflation is pointing out is that we do ultimately head back to that kind of 2.5% range. You know, take it or leave it, hate it or love it. You just think about, this is what the market's telling us. We look at it and make a decision based on that. Ultimately, I think inflation probably stays elevated for longer than is currently priced in, but that's something to worry about, I think 18 to 24 months out, not something that we do today. So as we think about this, if the market has started to price in a recession and asset prices have also done that, where are the potential opportunities in this case? And so historically, as you get these things start to be fully priced in, you know, some of the areas that present opportunities in the US, for example, will be US small cap growth. That area would be highly leveraged, have been hit very hard. You'd get some of the other areas like alternative energies. There's some companies that I like in the alternative energy space that, you know, are highly leveraged businesses that present really good opportunities because their stocks are down significantly as rates have moved up. So it's a bit of a rate trade and a good solid company trade. And then the last piece, which I comment on, is just China's credit impulse. So they've gone in the other direction. They went into a contracting economy first. They've come out the other side, and now they're starting to stimulate. Their economy is reopening. So I think the China credit impulse is quite positive for that area. And there's some ETFs, I think, in that space. I don't think you want to buy individual names there, but there's some ETFs there I think you can buy and put yourself in a good position over the next 12 months. So as we look at yield curve inversion, this is just another way of looking at it. You know, historically, as we invert, these gray lines and darker bars are the areas where we get into a recession. And so it's a recession, not the economy. So the recession, sorry, not stocks. So stocks looks like they've already come down. Now the economy is starting to catch up to it. And so I talked a little bit about US dollar on the front side. So I'll hit on a few things here, but you know, on a purchasing power parity basis is one way people analyze kind of what currencies are worth. You know, it looks like the US dollar is pretty heavily overvalued versus the global basket. And BCA's research says 24% overvalued. The yen was down somewhere in the neighborhood of 40% last year with US dollar. The Japanese economy did something unique, which we haven't seen before, which is they pegged their 10-year. And so they pegged their 10-year bond at 0.25. As a result of that, they're essentially saying we're okay with our currency getting demolished. And that's what happened. Their currency got hit up until a little while ago, where they changed. They went from 0.25 to 0.5%. Had a bit of a rally in the currency. It's probably overbought short term, but it's interesting to see, you know, that's the first country that's tried to put a peg in place. And really, it showed you that ultimately, when you do that, you're going to sacrifice your currency as a result of that. Another way to look at it, this is an HSBC report. U.S. momentum is stalling. Again, we've seen kind of a rally in the U.S. dollar, a bit of a correction now, probably another rally, but I think we're starting to see the end of that momentum here as the recession is getting priced in. A couple other ways just to look at it and how material the currency played last year, and just show you how things performed to the downside. In the weekly roundup we had last week, we had a couple clients ask about kind of the debt levels in the United States, and showing how massive the increase in costs has been. So when I have discussions with people that ask about interest rates, and There's kind of this view that we think rates can continue to go up and up and up forever, just like we thought they'd go down and down forever. Now as the U.S. Debt payments are approaching something like $800 billion a year, their economy can't grow if they're paying out this much. And so as that becomes kind of the number one line item in their costs. This is going to play a part into what they do, whether you like it or not. You think the central banks are involved in this. They're seeing this number as well. And I really think that this is important. And this is one of the reasons too why I think rates start to come down as they can't handle higher rates. And so just an interesting way we start to look, I'll talk a little bit about housing, because housing is a major part in the Canadian economy. It made up something in the neighborhood of 8% of GDP in 2021, excuse me. And so it's a major part of the economy, where the US would only be 2 or 3%. So in Canada's case, you're looking at something in the neighborhood of 70% home ownership, with roughly kind of 40% of that they own, 30% they own outright, and the other kind of own with the help of mortgages. And so with mortgage rates skyrocketing, this is playing a major part in the housing market. So we'll discuss how that plays out. So this is U.S. data. Obviously, annual mortgage cost is a percentage of income, with the 30-year, I think, peaked in October of last year. Most of the U.S. mortgages are based off of that 30-year. Only about 20% of U.S. mortgages are variable rate. So, much more sensitive to what happens in the long end of the yield curve. And so that's probably, you kind of saw kind of max risk to U.S. housing, I think, in October of last year. Now we're starting to see some of that pressure come off. On the Canadian side, obviously, variable rates play a bigger part. And so you'd see that kind of having a bigger impact in the Canadian economy. So this is capital economics research on that. And so again, we would talk, this is a little bit more about, the prices of real estate. And so if we look at the Canadian data here, so they're forecasting, or they were forecasting from peak to trough, something in the neighborhood of a 20% correction in Canadian real estate. What they factored in there is we're somewhere around 15% to the downside already with their current data. And so when you think about that, where are we in the curve? And so, I always think about investing in anything that way is, are we closer or further from the end? What do we do? How do we think about what we do from this point? And so this is currently what Capital's data says. Quite interesting. I tend to concur. I think it's interesting. But why all of this is relevant, and this is the GDP as a percentage, is the Central Bank of Canada knows this as well. And so as they look at this data and they look at the impact it's already have and starting to have materially, it's going to play a role in what they do with rates from here. And as I've said before, I think rates come down. And so I think that this is currently what we're seeing. And a lot of the stuff is priced into where we are today. And so these are the two kind of rates as we look globally. Global central bank we've seen hikes kind of across the board. And as we look at kind of where we are today, what's happening with central banks. And so as we look at the kind of the 4 places where there's been cuts, but I'd say really 2 that matter are Japan and China. And so we look at 2 of the major economies, they've started to cut rates. And so these are the early signals. They were the ones that went into the economic contraction first. They're the ones that are starting to think about where we go from here. And they've already started this cycle on the other side. So, I don't think we're quite there yet here in North America or in Europe. But this is, I think, where we're going based on how I'm interpreting the data today. And so I'll try to keep going here as we talk just about how this plays out and what it looks like. I'm throwing a lot of information at you today, so certainly feel free if you have questions as we go here. But these are the 4 quadrants which I've talked about, kind of growth and inflation, how they play off against each other. And if we look at what this means from a perspective of where we go from here, this is the forecast GDP. And so particularly in the US, I mean, Canada's GDP data is quite similar as well, but we're forecasting 2 quarters of negative growth. But on the other side of that, we're forecasting that we move into kind of growth accelerating and inflation decelerating, which is kind of the perfect setup to look at owning things like consumer discretionary, financials, materials, which is not stuff you want to own today, but stuff that you want to own soonish. And so today we're in inflation slowing and growth slowing, where you want to have some exposure to US dollars, to treasuries, to gold miners, things like that. These are kind of some of the assets you want to own with the current backdrop. This is more details of that. Certainly this presentation, as Scott mentioned at the outset, is going to be recorded, so you can go back and look at some of these things in more detail, but this is the breakdown of how the asset classes do in the different sectors. Excuse me. Okay, so what do we do and what do we have? And so history is a decent guide and gauge to think about where we are and what we do from here. And so I think about it, are we the 1970s or the 1930s? Are we kind of the mid 80s or the late 2000 teens? And so, you know, these are the reason that I picked these periods is we had a similar setup in all four of them, where you had the US dollar spiking 10+%, you had oil spiking, and you had financial conditionings tightening. And so in all four cases, we saw these. And so what do we have this time? And is it going to be similar or the same? You know, part of why we look at what's happened in history is it gives us a gauge for what's coming in front of us as well. So we think, is it going to be 1985 or 2019? And I would err on the side that this is where I think we're heading towards, which is we have a similar setup to we had at that point. So I think this is important to think about what could potentially come ahead of us. And I don't think history exactly repeats itself, but given the current setup we have, I think it's quite similar to these, where we see in 85, we had stocks up quite nicely. Obviously, treasuries up big as well. 2019, we had stocks up big, treasuries and gold up in that backdrop. And of course, Bitcoin, which just celebrated its 14th anniversary on January 4th, became one of the asset classes that performs well as growth accelerates and inflation decelerates. So it was up 87% that year. So how best to think about this, how best to play it? And so as I think about where we are, I do think that generally we've had a lot of the economic activity priced into stocks, where we had NASDAQ and the S&P both showing kind of really deep recessionary type numbers in their current prices. You know, I think the arguments I've had with other people that have said, you know, yeah, but what about the earnings revisions that we're going to see in the next quarter? And what about this? And what about that? You know, these are things that we already know. The market already knows that earnings are going to revise lower. We already know that that a lot of these companies, you know, projected that they're laying off people. We already know a lot of this data. So kind of, you know, as we look at that, we think, okay, well, what don't we know about what's happening? And what we don't know is that, you know, the markets to a major part have priced in a lot of the stuff that we're seeing here. As I mentioned, bonds, I think bond prices bottomed in October of last year, and yields, I believe, peaked, at least for the near term. And what do we do from here? So it's been many years, probably since 2018, where I would have said this, where I think it is much different this year than last year. And I do think that some of the dips and opportunities that present themselves should be bought. And so this is what I'd be looking to do as we roll out into 2023. I think about, you know, how do we position and how do we best do that? So there's lots of things to go through and cover, but this is an example about bonds. And so, you know, oftentimes I have conversations with people. They say, you know, why would I buy bonds? It doesn't make any sense to me. I don't understand it. And in a lot of cases, I'd say, you know, this is where I think some of the opportunities are. Even if you don't believe me from an equity side perspective, at least take a look at what it could mean from a bond perspective. You know, if you see if we saw a 3% reduction in the U.S. 10-year, so we saw the U.S. 10-year go from kind of 3.5 back to its all-time lows of 0.5%, and you own U.S. 10-year bonds, you make a 30% return in that backdrop. And so if we see 2% move, you make 20+%. If you see a 1% move, you make 15%. And so, sometimes it's important to think about, what's the likely outcome from here? And if you think the recession gets worse, then you have to buy bonds. If you think the recession continues and plays out as it is, then certainly you should have some exposure there as well. So this is how the curves moved up. It's actually, the bond market's de-risked a lot in the last 12 months, and it's moved the return profile into a much better stead. And just from a generational perspective, I've started my career similar to around this point in this chart that we're looking at. And this chart that we're looking at is Amazon. And so this is Amazon in 2000 up until essentially December of last year. And so, if you remember, similar to I do, that nobody wanted to buy Amazon at that point. It was a business that had future hope that maybe at one day it might be worth something. I think we're seeing that in some cases here. Amazon from 2001 up until December of last year returned 58,000% for an annualized 40% return over that period. And as we look through here and we kind of feel the fear that's going on, you look through and you look at a company hypothetically like Shopify. You look at Shopify down kind of 80–90% from its highs of a year ago, and you look at it and you say, has this business materially changed to be down this much? You can argue whether you think that's the case or not. But you think about where we're going, the digitization of business, finance, things like that. This is an interesting business. As I look through the rubble, I try to think about, where do these opportunities, outsized opportunities, present themselves? And maybe you can get exposure into a basket of them through an ETF to limit your risk. But I think there's some real opportunities if you're patient, that you can take advantage of them here. And so this was Citigroup's piece, just put out kind of its expectations for return from different asset classes. I like to take from different places and look and see where they expect the returns to be over the next 12 months. And so just when you look at this, what stood out and jumped out for me, and maybe it would be different for you, is really just like their expectations for returns on commodities. And so this is essentially zero-ish, with pretty much every other asset class performing better than commodities. And so, I'd say these are kind of the standouts that I look at when I'm looking at some of this research. So as I mentioned before, kind of valuations perspective, emerging markets looks quite good, with China being the one area that looks most opportune. Asia, again, it was the sector that went into the slowdown first, was closed for multiple years, and now it's starting to come out of the other side of that. So, one of the biggest challenges that we have is, how do we look forward? How do we see what's coming in front of us, and how do we position for that? And just a couple more slides, and then we can open it up to questions. But there's a lot of things to think about, and I've faced a lot of questions about crypto and Bitcoin over the years. So it's something I've been following for 3 or 4 years, and something that I've felt it makes sense to have some exposure to in portfolios. And so this is a sample of what it looks like from if you added a 3% position into a balanced portfolio, and just the return profile that's changed. It's actually increased your return and reduced your volatility. But I think it's something that we think about, and I do think blockchain continues to play a major role in the world. And so, we talk about this. If you follow my dailies, one of the charts that we have that we put up each day is either something related to green energy or something related to blockchain. And I think blockchain plays a major role in the future. Bitcoin is a part of that, but Ethereum, for example, would be much more of a blockchain that can be used to for positioning for potentially central bank digital currency or settling real estate transactions. So I think that the blockchain will play a major role in technology. We continue to learn about it and think about where that plays a role in portfolios and the markets, and we continue to learn about that each day. The last piece on this is just from a return perspective. And so as we think about the life cycle of it, after every big negative down year, you've had some significant outperforming years. And so I think it makes sense to have some exposure in your portfolios. And the last piece on Bitcoin would be M2 related. So historically, as liquidities come back into the system, you've had money start to move out the risk curve and can present some outsized opportunities. If you look at this chart longer term, the numbers start to point to how potentially how much upside you could potentially see as money starts to flow back into the system. Well, all these things I think play over months and quarters. I do think that we're in a better position than I've seen in a very long time. And so just to summarize that, I'll bring you back to what my base case is here, which is I think inflation moderates. I think inflation was going to moderate whether they tighten financial conditions or not. So they've overly tightened now to my view, and now they're putting serious pressure on the economy. And so that's going to speed up unemployment and continue to put pressure on households. And so I see that recession evolving, central banks going on hold. Right now we have CIBC and BMO saying that there's 25 more basis points in Canada next week. We believe that they're on hold. However, I think that we're extremely close to that, and we do think rates come down. Ultimately, with that as the base case, we think that there's positive returns for most assets and a weakening US dollar over that period of time. And, I think this certainly evolves, but that's currently the setup that we see happening today. And so just to bring it on back to where we started, the key, I think, to successful investing is having everyone agree with you later. So what can we do today to make sure we're in a position to benefit from what's coming ahead of us? And the other is be fearful when others are greedy and greedy when others are fearful. And so there continues to be a major amount of fear. We have massive kind of defensive buying protection in the markets, and people are really still kind of in that fearful category. So I think we have some of the better opportunities than we've seen for at least 4 or 5 years, and I'm excited to take advantage of those and make sure that we're positioned for what's coming ahead. And so that's it. I got through it in 52 minutes, Scott. So I appreciate you listening and going through the presentation with me. We do offer a number of different things that we do right now. We do a daily email, and we do a client-only weekly roundup, and we do quarterly and semi-annual outlooks, which will go into much more detail on what and where things are, similar to this presentation. But I hope you found that useful and provide some information for what we expect to happen in 2023. A quick update on what happened last year, and I appreciate you taking the time to listen to the presentation this evening.
Awesome job. We just have one quick question here so far. If anybody else has one, then please put it in the Q&A down at the bottom of your page there. Just from Lyle, what are the main indicators you track to determine direction and pace of the markets, and which are lagging and which are leading?
So that's a good question. So most of the economic data that comes through is lagging, and employment tends to be the one that has the biggest lag. So as I think that's the last shoe to drop, as I say. I think that ISM number tends to be a decent one from a perspective of if we're in it or not. And most of the ISM data that came through in December tipped over and is below 50 now for the first time, effectively saying that we're in the early stages of a recession. And so from a leading perspective, I'd say it's the market that leads us. And so if the market led risk assets lower, and now we're starting to see it start, like bonds and risky areas starting to move out the other side. The market's starting to say, maybe we're comfortable with how low things got. And, just to kind of bring back a little bit of context for what that meant in the 70s when Volcker went on this kind of serious rate tightening cycle, the S&P corrected about 28% that year, similar to what we saw in the last 12 months. So I'd say, stocks tend to be the forward guidance for what's happening with the economy and bonds.
Okay, great. No other questions at this point, so we'll assume that's it for today. Anything
Perfect.
you wanted to wrap up with there, or?
I'd say, I think that there's continues to be a lot of uncertainty in the world, but this is typically when the opportunities get presented. And so I would say that, we spend a lot of time thinking about what's coming ahead, and, where's that risk reward. And so, if there is anyone that has specific questions that is interested, certainly you can shoot us an email or give us a call, and we can address those. But I think, as I say, I think this is the kind of December, January, there's been some of the best opportunities that I've seen in many years. And so I'm excited about what's ahead and trying to make sure we're well positioned for that.
That's great. Okay, well, then we'll wrap it up there. Thanks everybody for watching, and hopefully we'll talk to everybody soon. Have a good evening.
Thanks. Take care.